Okay, welcome to the September 13th edition of the Fats, Fuels, and Oils webinar. It's been a couple of weeks since we've been together, and a lot has happened. Well, particularly with the with USDA's monthly WASDE report. USDA surprised the market and certainly me by cutting soybean production by 152 million bushels on a 580,000 acre decrease in acreage harvested area and a 1.4 bushel reduction in soybean yield. The decrease was surprising to me because I thought that there were enough timely rains in the Western Corn Belt to support higher yields. And apparently, not only was that not true, but probably the crop in the Eastern Corn Belt is a little bit worse than expected as well, just based on the results from the Pro Farmer survey a couple weeks ago, or several, 2 or 3 weeks ago. The important part about the decrease in production is that effectively it dropped in carry out for new crop to 200 million bushels, which is probably about pipeline, probably about as low as stocks can go. Now, obviously they can go a little bit lower, but effectively it's probably relatively close to what we would consider pipeline. And relative to usage, that number of 4.5, the stocks to usage ratio of 4.5%, is the lowest that we've seen since 2013 and 14. Now, it was lower the year before, and if you look at the difference in stocks and usage from the year before to this year, and production and usage have both risen about 1 billion bushels. And so 100 million bushels above the lowest stocks number, which was 92 million bushels, kind of feels about right. Again, maybe it could be lower. I think back then I probably would have said that that pipeline was around 100 million bushels or 125 million bushels. And so you can see, like, maybe the final number can be a little bit lower. But the main point is that further reductions in USDA's U.S. soybean production forecast will mean further cuts to its demand projections. And this month, it offset the 152 million bushel cut to its production forecast with a 70 million bushel reduction in its export forecast and a 20 million bushel reduction in its crush forecast. The sort of the theme that we've been talking about for quite a while now, it started with the canola crop in Canada last year, when that fell short of sort of the market favoring crush over exports, is likely to continue in the US. And while the US crop isn't that much, it's the reduction in production isn't nearly as significant as it was in canola last year. Going forward, if there are further cuts to production, then USDA probably will likely continue to favor, and I will continue to favor, reducing US exports, especially given the fact that if La Nina goes away, we probably have a significant increase in South American production, and so China can source a lot of soybeans out of Brazil, effectively, is what it comes down to. So you can cut US exports by a significant amount. Now, if La Nina doesn't go away and Brazil can't export a lot of soybeans to China, then we have a whole nother situation. But I think that that even if Brazilian production or South American production more broadly doesn't reach current expectations of 151 million tons in Brazil, even if that falls a little bit short of that, China can still source a lot of soybeans out of Brazil. And this year's data for China would suggest that maybe the soybean meal demand there is not as large as we all thought it would be as they came out of the giant herd liquidation from ASF. Everybody kind of thought that that the Chinese hog industry would sort of modernize, and that would make soybean meal feeding much more intensive. And while that's been true, I think that it's probably fallen a little bit short of expectations. And so China probably doesn't need quite as many beans maybe as I would have thought several months ago. And so again, as long as the Brazilian crop kind of gets back to something much closer to normal than it has been over the last couple of years, I think it's safe to say that that any additional reductions in production in the U.S. again probably mean lower exports and maybe a little bit lower crush forecast. The size of the crush forecast is obviously important for soybean oil, and the demand for soybean oil for given the growth in renewable diesel production. On USDA soybean oil balance sheet projections, the cut in crush reduced USDA soybean oil production forecast by 235 million pounds to just over 26 billion pounds. That's 1 billion pounds less than we're projecting. Not because our crush forecast is so different. Our crush forecast is 2.275 billion bushels, and USDA's is 2.225 billion. So only 50 million bushels difference in crush, but 1 billion pounds difference in production. And the main reason for that is that USDA is projecting an average soybean oil yield per bushel of 11.56 pounds relative to our forecast of 11.81. Now, ours might be a little bit high. This past year, it looks like we're going to be somewhere between USDA's forecast or estimate almost at this point of 11.79 and ours of 11.84. But I think that it probably is likely to be well above USDA's 11.56. And so even if USDA does cut their crush more, they have room to raise their yield forecast and continue to leave soybean oil production relatively unchanged. Now, soybean oil yields depend a lot on the weather conditions during pod filling. And so warmer and drier weather generally result in higher yielding, higher oil yielding, or higher oil yields, I guess. And while there were times that there was a lot of rain in the eastern Corn Belt, the western Corn Belt, like I said, kind of received timely sort of periodic rains. And I think generally overall for most of pod filling, or for most of the past month, temperatures have been normal to above normal. So I think one, you can probably make the argument that just the amount of oil in the seed is probably going to be higher than average. Whether it's a little bit higher or a lot higher, it's probably too early to know, and we probably won't really know that until we start to get crush data for October and November. But the other thing is, and I talked about this a long while ago, is with soybean oil prices at current levels, crushers can do things that will increase the soybean oil yield, or effectively get as much of the oil out of the soybean as they can. And so I think all of that means, again, that probably USDA's current yield forecast is a little low. It's probably going to have to come up through the year. And the other key takeaway, I think, from USDA's report is that yields are probably not going to be above where we were last year. And that's a little surprising to me because I think I've shared on this call a conversation that I had at this point a couple of years ago with some people in the seed industry, and they were really fired up about how the new seeds were going to perform. And we talked about how yields kind of do this stepwise function where you get the invention of fertilizer, let's say, and yields jump up and then they kind of go sideways for a while, and then you get GMO and yields jump up and then they kind of go sideways. And that conversation made me think that we were kind of at the beginning of one of these cycles. If this year's crop really is going to yield less than 51 bushels an acre, I think that conditions weren't optimal this year, but the big emphasis from the seed industry was improvement in yields with below normal moisture totals. I think that probably means that trendline yields going forward probably are. I'm probably going to adjust those down a little bit just based on the performance of the crop this year. Now, that's important in the longer term because as demand for soybean oil rises with growth in renewable diesel production, there will need to be more acres devoted to soybean production in the U.S. Than there would be if this year's yields were going to be 52.5 or 53 bushels an acre. And it's not clear based on this year that U.S. farmers, at least at this point, are willing to shift the acreage mix sufficiently to support that growth. And I don't mean to paint this as some dire situation where, soybean oil goes up to $1.20 or something like that. But this report was important because of not only the impact that it had on the market yesterday with soybean prices rising 75 cents and all of that, but it also has implications for the longer term. And so I think that it's important to point that out, and we kind of will see where USDA tends to go from here. The September report typically is not a report that features huge changes. And in fact, if you look at sort of the month-to-month changes in USDA's yields forecast historically, or at least since 2000, the average change in September is the smallest of the months that USDA reports or predicts yields. That doesn't mean that I expect bigger changes in the coming months. It just again points out probably a little bit how surprising the change was this month. All right, with that, let me share my screen and we'll talk about what that meant for our price forecast. So while we still have kind of a downward sloping price forecast, the level has generally moved up. And if you look sort of for analogous years, at least in terms of setup and price action, this year actually does match up relatively well with 2014, which that was the last time that the stocks to use ratio was this low. And in 2014, prices went up and then they bottomed in the summer, July of 2014. And then when the market figured out that stocks were going to remain tight, we were coming off the 92 million bushel carryout the prior year. When the market figured out that stocks were going to remain tight, the market rallied through April. And then as the South American crop came in, then started to go down again.
And I think that for my soybean price forecast, I've kind of mirrored that. I haven't taken prices up through April, but prices I've taken prices. I've raised prices month to month from now through like February, and then started to decrease prices after that, because between now and when Brazilian harvest gets underway in earnest, while there will be a lot of soybeans from the US harvest, there's going to be a substantial demand on those soybeans, and the market's going to have to kind of go to a price that figures out exactly who wants to pay for those soybeans. Now, once we get to the Brazilian harvest, then again, assuming that we go back to 140, 145 million tons, 150 million tons, then prices can probably go down. Now, typically, I think that would mean that that soybean oil prices would follow soybean prices generally in trend. And in this case, we don't really necessarily have that. We kind of, again, have sort of this downward sloping forecast. And that's due in part to the fact that that we do expect crush to rise to a new record next year. We expect the soybean oil market to remain well supplied. And so while the price kind of goes down slowly, it goes down slowly from a higher level and more slowly than my previous forecast. If the growth in renewable diesel feedstock demand is greater than we expect, then probably the shape of the price curve will look a little bit different, or the shape of the forward forecast curve will look a little bit different, and will look a little bit more like the soybean forward curve, which again, up through February and then kind of down. Let's see, I guess I wanted to pull this up. Hopefully this kind of works. You can see for new crop, the other changes that that USDA made is they cut their forecast for biofuel demand by 200 million pounds to 1.8 billion, and that left about 50 million pounds to fall to ending stocks, which raised our ending stocks to 1.826 billion. Our ending stocks forecast kind of remains around this 2 billion pound level, and I talked a little bit about this in recent weeks about the idea that while there is a lot of anticipated growth in renewable diesel production capacity and growth in feedstock demand, based on some changes that we've made about around assumptions on, at least in the short term, on biofuel imports and some other changes that we've made, we kind of think that again this year, soybean oil stocks, this will not be the year that soybean oil stocks tighten dramatically. We think we kind of continue to go along around the same place that we have been over the last couple of years and traditionally, which is kind of, at least for a lot of years, and certainly in the last 5 years, a couple 100 million pounds one side or the other of 2 billion pounds. And so despite the fact that that I've increased prices, that's much more a function of the increase in soybean prices than it is in changes that we've made to our soybean oil forecast. For canola oil, USDA didn't really make any changes. It kind of trued up its old crop balance sheet to the data that we had, and on its U.S. canola oil balance sheets, it raised production slightly on a higher crush number that came from an increase in U.S. canola imports, and offset that with a change in its domestic use, where it raised biofuel and non-biofuel demand both by 50 million pounds, and that took its ending stocks number down 8 million pounds to 149, which is roughly 48 million pounds below our forecast of 197. We don't really have a lot of big disagreements in our canola oil balance sheets and our U.S. canola oil balance sheets with USDA, and so I don't, the 50 million pound difference in ending stocks, not really a huge difference in my mind, and so not much that I disagree with there. The one thing to note is that next month USDA will update its canola acreage and production forecasts. And so if there is a significant cut in the U.S. canola production, then again, while any reduction probably will favor exports over crush, for canola, we don't really export that much, and so the bulk of any cut will probably have to come out of crush. Now, the Canadian balance sheet features a significant recovery in production from last year, and so there is a recovery not only in our forecast for Canadian canola crush, but also Canadian canola seed exports, and that is part of why I think the USDA's move to increase U.S. imports probably makes sense, because there's going to be more canola seed around. Last week, Canada released their not quite quarterly, they actually do it 3 times a year in an odd way, where they do it quarterly, and then there's like a half a year before they do the next. Their stocks numbers, and that came in surprisingly low at 875,000 tons, which was below our expectations, and but it was above USDA's, and so all of that contributed to an increase in supply. But they offset that increase in supply basically with, they raised their crush, lowered their exports, and that left the increase in supply to fall to their carryout. Now, for canola, their carryout of 2 million tons is well above ours of 1.15 million. Given the lower than expected stocks that we saw this year and the strong demand for canola crush and probably canola seed exports next year, we think that it's probably going to be a little bit tougher to build stocks than traditionally. Before Stats Canada released their stocks number, we had stocks higher and had them building back relatively quickly, which has happened in the past in Canada. But given the lower stocks number, I think we probably are in a little bit different regime. And again, it's probably going to be a little bit tougher to build stocks. And so with a crush that's likely to be record high this year, and exports that probably are going to be still below sort of where the long-term average is. Again, I just think that stocks may be a little bit difficult to build in Canada. And what that meant for their canola oil supply, the increase in crush raised their production number by 102,000 tons, but it still is significantly below our number. And this is much more a function of crush than it is of yield. In fact, I think our canola oil yield may be below the USDA's canola oil yield for Canada. Our canola oil yield projection may be below Canada's canola oil yield projection. They have domestic usage that is relatively steady, and we've got domestic usage going up on rising demand for biofuel feedstocks. And then we also have exports a little bit higher than they do, but not significantly.
the big difference between our ending stocks number and their ending stocks number just has to do with the difference in the series that we reconcile to. We don't reconcile to USDA's ending stocks number, and Stats Canada doesn't really publish an oil stocks number, and so we use an oil stocks number from one of the trade associations is what we reconcile to, and so that's why there's always going to be a big difference between our prediction for ending stocks and their prediction for ending stocks. Okay, on to palm oil. The Malaysian Palm Oil Board released their monthly report on Monday, and it showed palm oil stocks rising to the highest level in 33 months and well above 2 million tons. Bigger production and slightly lower exports were the main drivers of the big increase in ending stocks and the increase above where we had expected and where market expectations were. As a result, we made some changes in also imports. Sorry, I forgot. Imports remained really strong in Malaysia. As a result, we raised our production forecast by 50,000 tons and our import forecast by 250,000 tons. Based on the export data, we didn't really make any changes to our export forecast. And so that took our ending stocks number up to 2.15 million tons. Again, I think that the market probably has anticipated this and priced a lot of this in. And so I think that while we've talked about sort of the 2 million ton level being the line where, you know, above 2 million tons prices go down, below 2 million tons they go up. Given the fact that the market has already come down pretty significantly from its highs, and the spread between palm oil and soybean oil, or soybean oil and palm oil, has continued to rise, with the nearby contract rising above 35 cents this week, suggests that exports may start to pick up, although we really haven't seen a lot of evidence of that. And in fact, the US soybean oil exports for data for July was much stronger than expected and much stronger than suggested by the weekly export shipment data that we generally get on Thursdays. And so the big increase in spreads has yet to be reflected in the importing countries deciding to substitute palm oil for soybean oil in a significant way. It looks like that probably continued in August. We only have half of August's export shipment data because the USDA is introducing a new way to report exports on Thursday. So it's a little tough to tell, but at least halfway through the month, it suggested that exports could be as high as 80 million pounds in August. And if that's the case, one, USDA probably is going to need to raise their US export forecast. But two, it means that Malaysian palm oil exports probably aren't going to pick up really significantly, at least through the end of the marketing year. I think that they may pick up early in 22-23. And you can see that we've got kind of a little bit more than a 1 million ton increase built into our forecast. But if we don't see evidence of that, even with the spread at 30 cents or 25 cents really for the 27 cents for the most actively traded contract, if we don't see evidence of switching, then we probably ultimately will end up cutting our export forecast as we get sort of the initial couple of months of data in 22-23. That probably means that that stocks will maybe rise from the 2.1 million ton level, and in that case, then I think that prices could fall a little bit further, but I think they'll be constrained by
by what's going on in soybean oil prices. And again, while we've got them coming down, we don't really have them dropping off as much as we did before this report. All right, let's get on to biodiesel. So biodiesel margins, as they seem to generally do, sort of moved in opposite directions again this week, with our estimate of biodiesel profitability rising to $1.14, which is the high per gallon, which is the highest level since early July, while renewable diesel declined slightly, but is still in this sort of 230, 225, 240 per gallon range. And we expect that that renewable diesel kind of continues in that range through much of the end of the year, because fats and grease prices are generally close to or at record levels. And so the margin for renewable diesel, or at least our estimate of renewable diesel, will depend more on energy prices, I think, than it will on fats and grease prices. All of that said, if soybean oil tends to follow soybeans more and soybean oil prices go up and set new highs, then it's possible that fats and grease prices will also break out to new highs if the demand for soybean oil falls because it prices itself out of the feedstock mix, and the demand for fats and greases in the feedstock mix picks up. For biodiesel now, we think that based on our revised soybean oil forecast, we think that margins probably slowly work their way lower through the end of the year. All of this is based on the idea that energy prices come down. And if you look at the fundamentals of the energy market, I think that you can make a strong case that energy prices remain at current levels or even move higher. But if you look at the potential for an economic slowdown in the US and maybe globally, today's CPI number came in higher than expected, and that means that it probably means that the Fed is going to continue to raise rates for maybe longer than the market was expecting before. That probably will ultimately pressure energy prices, because demand will likely fall as the Fed raises rates and as interest rates rise. So the energy prediction here turns out to be, I think, probably more important than the feedstock forecast, at least from margins perspective. The other thing, obviously, that is going to be important is RIN prices. And so if we go to our RIN forecast, this week we raised our RIN price forecast. D4 rate went up on the idea that soybean oil prices are going to be higher. D6 kind of, the model really wanted to take D6 prices down, but it's hard to imagine that that D4 prices are going to rise to new highs and D6 prices are going to not collapse, but the model kind of wanted to take D6 prices down below $1.50. And that would have blown the spreads out to sort of 40 or 50 cents, I think, something like that. And so we adjusted that a little bit, raised D6 prices a little bit from where the model suggested, and lowered D4 prices a little bit from where the model suggested, to kind of keep the spreads sort of in the same sort of ranges that we think, which is kind of tightening through the end of the year, then obviously widening in the beginning of the year, and then tightening again towards the end of 2023. We are in the middle of sort of thinking about RIN prices, not only in the short term, but in the long term, in view of the changes to the blender's tax credit that are imposed by the Inflation Reduction Act. and what that means for feedstock consumption, and then again ultimately RIN prices. And I think the difficult part about that problem, I think that the early takeaways are that the value of soybean oil as a feedstock, or the attractiveness of soybean oil as a feedstock, goes down, because instead of $1 a gallon for everybody, the new credit, which starts in 2025, will be based on CI scores. And there are a lot of views out there about what that will mean for the value of the credit for soybean oil, that sort of range from 0 to 60 cents, essentially. And if you think of RIN prices as or the function of RINs as kind of to encourage enough production to meet the mandates, that means that what they need to do is kind of ensure that margins remain at levels that that generate enough production to meet the mandates. And so if you take soybean oil, the value of soybean oil down, or you decrease the amount of soybean oil that's used as a feedstock, then naturally at some point, as you run out of fats and greases, you're going to either have to come up with new feedstocks, which is not impossible in 2 years, but I don't think you're going to replace all the soybean oil that you would need to replace if the blender's tax credit completely went away for soybean oil. And so I think RIN prices offset part of that decline in the blender's tax credit. Again, it's something that we're working on. We've kind of started to look at it, and that has been sort of our first takeaway. And as we kind of firm up our views, one, they will be available in our long-term forecast, obviously, but we'll probably talk kind of generally about what we think it means over the longer term on this call as well. LCFS credit prices, we didn't really change this week. LCFS credit prices kind of continued to move a little bit lower in the past week, not really quickly, but still not recovering. So we still have kind of the same shape built into our curve that we had last week. All right, with that, there are several questions. So let me quit sharing. And what was the report issued yesterday that sent soy prices today to 75 cents a pound? Sorry, I think I probably wasn't quite clear on that. So yesterday, the United States Department of Agriculture released its monthly supply and demand report, the World Agricultural Supply and Demand Estimates, or WASDE report. And it didn't send soybean oil prices up to 75 cents a pound today. It increased soybean futures by 75 cents yesterday. So soybean futures yesterday went from $14 a bushel to $14.75 a bushel, essentially. How do you forecast canola oil prices? For canola oil prices, what we do is, because the series that we report is the Los Angeles series, what we do is we look at the historical spread between soybean oil and canola oil. We make some assumption about what we think that spread is going to be. And then we look at the prices from that and compare the prices that are generated by the spread with prices that are generated by a model based on the fundamentals for canola oil. And we compare those and then make adjustments to the forecast based on input from both of those, essentially. Can you speak a bit more about how CI affects the producer's tax credit in 2025 plus? So just kind of quickly, the lower the CI score, the higher the value of the credit. And so there are again, I think there are people that are interpreting the way that the CI score impacts the value of the credit generally, so that there are views that that again range from sort of for soybean oil, which has a CI score of, let's call it 50 or so, the credit will essentially be worth zero. And for the fats and greases, obviously it will be worth more. The lower that your plant gets its CI score, the more valuable the credit can be. I think there are also some differing views on whether the value of the credit is capped at 125 and 125 for biomass-based diesel and 175 for SAF. I thought that those were the caps, but I think there are some people that don't think that that is necessarily the case, and so it doesn't necessarily mean that if your plant only uses soybean oil as a feedstock, then that's going to be your CI score. If your plant uses soybean oil and UCO and some other things, and then they do some other things to reduce their CI score further, then I think that that the credit is obviously the blend of your feedstock mix and your overall judged CI score for the plant. What it means in the long term for soybean oil demand, I think the first take would be that that because soybean oil, canola oil have higher CI scores, that the new credit will disincentivize their use. And I think that that's partially true, or I think that's true at first glance, and it may be true, it may actually be true. But if you think about the LCFS program, what this does is essentially this brings the elements of the LCFS program to the national program without having to rewrite the whole RFS. And so if you think about the LCFS program and the way that it works and what it means for what those credit values mean for feedstock consumption, you haven't seen the complete elimination of soybean oil in production that is headed to California. In fact, it accounts for about 15% of the total feedstock demand, if I'm remembering the last quarter's numbers correctly. And so again, while I think that it probably does reduce, well, I think it's obvious that it does reduce the value of the credit for biofuel producers using soybean oil as a feedstock. I also think that in these markets, nothing occurs in a vacuum. And so you probably have an increase in RIN prices to make up for that loss, that decline in margin. The question is, will RIN prices rise enough to completely offset that decline in margin? And so if they did, then theoretically soybean oil use wouldn't be changed really at all. If RIN prices don't quite rise as much to offset the loss in value, then maybe there is some reduction in soybean oil or vegetable oils more broadly. However, there is a cap on fat and grease supplies. And so unless we're going to start growing camelina or some of these other sort of cover crops in a big way and build out a lot of infrastructure over the next 2 years to handle those and get those into the feedstock mix, I think that it's very difficult to imagine that we could make the current mandates, let alone make mandates that are rising from year to year. At least we expect them to rise, not a lot, maybe 2% year to year, without using vegetable oils. So I think that, again, it's very easy to have a first take on this, but having a real understanding of what we think about the impact of this is going to take a little bit longer. But again, hopefully, well, it will be reflected, at least our understanding at the time will be reflected in our long-term forecast, which we're going to release this week. I'm not saying that we won't change our thinking about it before next quarter, but I'm trying very hard to understand this and make it so that what appears in this quarter's report is consistent going forward. Not that I've obviously been wrong in the past and may be wrong about this and may need to change my views 180 degrees on this, but trying to understand it as much as I can. What is import parity, the import parity price of soybean oil? So for soybean oil, the import parity price would essentially be, depending on the exporting country and your freight to get it here, whatever that may be. From that, then you add 19.1% for the U.S. tariff on soybean oil imports, and that would get you your import parity price. So if we just, and excuse me for looking off screen here for a second, if we just look at today's futures, if we look at December futures, we'll call it 66.5. And you would add 13 cents to that for the tariff. So 79.5 cents plus whatever you have, for transportation costs from wherever you're importing it from. I would assume it would be probably Argentina. And so then you're probably going to add another, I don't want to say shipping rates because I would probably be way off, but you're going to add the shipping rates on top of that. So the import parity price out of Argentina probably is going to be somewhere around the 80 cent range. Now there is a big basis differential between the US Gulf and Argentina, and at least a week ago that differential was 17 cents, and so you get 17 cents back there. And so actually maybe the import parity price is a little bit lower than, maybe it's right around where futures are today. Maybe there's not a huge difference by the time you add the tariff, subtract the basis differential, and add your freight. Maybe it shakes out to about where December futures are trading today. All right. There was also somebody with their hand up. So I'm going to try and do this. We've never done this before, Javier. And so I'm going to try and allow you to talk. And if this works, this will be great. If not, if you can type your question in the Q&A part, then we'll do it that way. But if I'm going to try and do this, so go ahead. But you'll need to take yourself off mute.
Yes, can you hear me?
I can.
Okay, great. Hi, Tor. I had a question about the UCO forecast. It says, well, in the report that you wrote, it said it looks like in the graph that it will increase until about like October or November, and then there will be like a decrease around like January 2023. I was just wondering, like, what information are you basing that that forecast on? I mean, the rise in October, November, and the decrease in January. That's my question.
Okay, thank you. So the UCO price forecast looks kind of generally like a lot of the fats and grease price forecasts. So this week I wrote about BFT, and it kind of had the same shape to the forward curve, where it's kind of rising through the end of the year and then kind of decreases a little bit, or it's close to record levels essentially through the end of the year and then decreases a little bit at the beginning of the year. There's generally relatively strong seasonality around biofuel production heading into the end of the year for RIN compliance purposes. Generally what happens is that in November and then especially in December, you get producers that increase production substantially because obligated parties need to meet their individual renewable volume obligations, and so production needs to be whatever it is to kind of meet those. And then you get a decline in production in January and February. Now, the decline in production historically not only has been driven by the fact that sort of you just got the end of the compliance cycle, and so you have now a whole year to meet your next renewable volume obligations, but also because biodiesel didn't quite work as well in cold weather as renewable diesel does, or as even new biodiesel does as well. So we've seen a little bit of a temperament, a little bit less seasonality in production over the past couple of years. Some of that has been due to some other factors as well. There's a little bit less of that, but there still is a very strong seasonal tendency. And so because of that, that's kind of why you see the shape of that, where you see in what I would say about UCO or fats and greases more broadly, is that prices remain at or slightly below or maybe slightly above sort of the record levels that were set earlier this year through the end of the year. And then the first chance for them to decline is kind of in January and February as renewable fuel production kind of tails off. Now, that assumes that that the soybean oil price forecast doesn't really change that much. I think, like I was saying earlier, I think if the soybean oil price forecast changes from what you see right now to one that soybean oil prices also go up and set new records in the next couple of months, then you probably have a steeper curve into the end of the year for fats and grease prices, because as for any sort of pound of soybean oil that comes out of the feedstock mix, a pound of fats and greases likely needs to go into the feedstock mix. Given that the supply is relatively fixed, we could start to get into a spot where we probably have used up all of the fats and greases that we possibly can for renewable diesel production or renewable fuel production, and we need to start buying pounds back from the feed industry or the oleochemical industry or the food industry. A couple of those are very expensive. The feed industry may already be getting priced out of some of the fats and greases. Once you start trying to go against some of the food and the oleochemical folks, they can pay a lot more for fats and greases than the biofuel industry can. Now, UCO is kind of a special case because there isn't necessarily a lot of non-biofuel use, and its supply can maybe expand a little bit more than the other fats and greases. And so even if we get a big increase in soybean oil prices, UCO prices probably come up a little bit, but maybe not as much as some of the other ones like tallow, which is also very popular for renewable fuel production, but definitely has a fixed supply, whereas the UCO supply is kind of fixed, but it also kind of can be increased a little bit. And there are some in addition to sort of the traditional sources of UCO that you think about, restaurants, food manufacturers, that kind of thing, there are also some sources of UCO that that may become economically viable as prices rise. All right, I hope that answers your question. I got one more question. Do I know if ethanol qualifies for the full $1 a gallon in the producer's credit 2025 plus? Is there no adjustment for the lower energy density of ethanol compared to renewable diesel? Yes, I think that that ethanol and other fuels also qualify for the credit. So I think I believe, and I'll have to go back and confirm this. So please send me an email. But I think that that ethanol and the other fuels qualify for this credit. I don't know if there is an adjustment for, I know there's a difference between SAF and renewable diesel. I don't know if there's an adjustment for the other fuels off the top of my head, but send me an email and I will I'll dig into that a little bit more and I will answer you. All right. Okay. Thank you everybody for hanging out. I know this has gone almost a full hour and I really appreciate the time that you spend with me every week. And I look forward to seeing you all next week. I hope everybody has a great week. See you later.